Okay, welcome to Trading the Gap Part 2. So last week we discussed what is the closing gap and the extreme gap and why do we trade it. We also left you with a little snippet that if you trade every single closing gap with an end of day stop, it's an unprofitable strategy. It's actually just break even. So you don't win, you don't lose, but we're certainly in trading we do want to be winning. So in order to make the strategy profitable, we're going to look at four components today. We're going to look at selection, we're going to look at entry, we're going to look at stop criteria and our exit parameters. We're also going to take an example just from yesterday in our live trading room. So for our trading plan, we're fading the common closing and extreme gap. So the common gap is linked to the previous day's close, and the extreme gap that's linked to the previous day's highest price or lowest price. If we open above the highest price, we have an extreme gap to the upside. If we have an extreme gap to the downside, we're opening below the previous day's lows. We need to filter out and identify our high probability trades. So I'm going to give you one key filter out of our four filter process today, which you can take away and you can start trading gaps tomorrow for yourself. Now, if we avoid the large losses, we'll take the profits will basically take care of themselves because the strategy has a 70% hit rate. So in order to make that really profitable, we need to make the risk reward 1-to-1. That means if we're risking 10 points, we want to be making at least 10 points as well. It doesn't have to be exact, but near enough. If we don't use the gap, we can use the advanced 5-minute bar system, or we can use the spike system. Okay, so we don't have to trade the gap every day. Again, it's all about selection, waiting for those real high probability trades to come along. But again, if we don't trade them, we can fall back on the spike or the 5-minute bar. All right, so for the entry for the common closing gap, which is linked to the previous day's official closing price. Remember, get that from a reliable source such as Bloomberg. We covered that last week. We're going to trade most of these gaps at the open. So that's pretty good. It means that you can wrap your lifestyle around that. It doesn't really matter if you're busy or you're going to work. We know that 8 o'clock UK time, which is 5 p.m. Sydney at the moment, clocks do change throughout the year, so do check that. We know we're going to have to trade that gap, and it's going to take around 5 to 30 minutes maximum. So most of the gaps you can trade at the open or within that 5-minute period once the market opens. For the DAX and the Dow, these have greater volatility. So what we generally do is we wait for a 5-minute bar to confirm the trade. So once that's broken in the direction of the closing gap, we'll then get in. But for the FTSE, you can sell or buy in that first 5-minute period for sure. The stop for the closing gap is 30% ATR of the 5-day average true range. That's what ATR stands for, average true range. And also for the FTSE, it's also 30% ATR. Now, the reason we pick an ATR is that the stop will therefore basically change as volatility moves up or down in the market. Therefore, the stop is always going to be different and will adjust to market conditions, which is very important. That's why you find a lot of systems, they phase in and out, because the market will be doing something, then 6 months later it will be completely different conditions and that system no longer works. But for this one, we are certainly adjusting every day. We don't want to be risking more than 2% of our bank or our trading account on each trade, so make sure that you leverage accordingly, and if you have a bigger stop, you just simply lower your leverage or your pounds or dollars per point that you're placing on the trade. For the targets, we're not going to target right on the closing gap because of the fading the fill scenario. So what that means is that a lot of the time the market will come down towards the closing gap. Just say the closing gap is 6,000, it might get to 6,002 and you'll see buyers come in. So we want to be getting in around 2 points before the target, and for the Dow and the DAX, which are bigger indexes, we want to be getting out 4 points before the target. Now for our selection tools, we're going to give you one free one today. It's the pivot chart selection tool. There are of course 3 others: the hot and cold zones, the patterns, and the market days, but we're going to gift you the pivot today. So what is the pivot? Well, actually this is your pivot table here. Now you can see we actually email this to our clients every day. Now if we take the FTSE down here, the ones we want to be focusing on is S1 pivot. So S1 pivot is 58.92 for yesterday, and we want to be looking at R1 pivot, which for yesterday was 5993 on the FTSE. So what we're saying for this particular filter is if the market opens between S1 and R1, then there's a good chance the gap's going to fill. But if we open beyond S1 or R1 at the open, the chance of the gap filling is reduced. Okay, so the reason for this is that stops or new buyers or sellers will likely be lying beyond this region, beyond this S1 and R1 region. So therefore we want to avoid the gap if we're beyond that region. Likewise, if we do open within the region, then the closing gap, and certainly if the closing gap is less than 25 points, there's a real good chance of gap fill. And we can use that standard stop, as I mentioned, which is 30% of the 5-day average true range. Okay, this is an example from yesterday in our live trading room. We actually identified that the closing gap was likely to fill, and you'll remember that these are the pivot points here, S1 and R1. You'll notice that we opened at 59.19, so there was no pivot risk yesterday. So, and this is just one filter, remember. The other filters weren't identifying risk either, so we were happy to go for the gap. So you could have just bought the open with a 30% ATR stop. I mean, let's just have a look at what 30% ATR stop would have been. It would have been 34 points. Now if we go back to the open, we'll see that the open was 59, let's just call it 20, and the target was around 19 points higher. So in this circumstance, it doesn't really make sense to buy the open because the risk reward is not in balance. So therefore we can look to do something else. We call this waiting for a spike. So what this means is we wait for the market to open, and we wait for the market to move down to a point at which the risk reward does make sense. So in this case, if we're opening around 59.19, then and the target's 20 points, then we need the market to move down to around, well, at least 5900 to 58.99. That was the area you'd be looking at, and that's exactly what we did in the live room yesterday. We were looking for a spike down because we identified the closing gap as high probability is filling. Unfortunately, for yesterday, it got down to around 59.14, so came shy of our 14 point. So we really just watched the market move up and fill the gap, which can be frustrating, but it is important to get that risk reward right if you're trading these gaps. Okay, so hopefully you found that useful. Please do let us know how you're getting on with your gap trading. Take that little filter away, let us know how you're getting on. And of course, if you want the full Trading the Gap for a Living course, please email us and we'll give you further details. Join us for a new tip next week, and take care.